Have you ever wondered why some of the smartest people you know make the worst financial decisions? It's a puzzle, right? You'd think a high IQ would automatically translate to a high net worth, but that's often not the case. Today, we're diving deep into the minds of two of the greatest investors of all time, Warren Buffett and Charlie Munger, to uncover why intelligence isn't the key to wealth, but something else is. Stay tuned, because what you're about to learn could completely change your relationship with money. What if I told you that your biggest enemy in investing isn't the stock market, a bad economy, or some slick Wall Street trader? What if the enemy is actually you? Buffett and Munger have built their empire, Berkshire Hathaway, on a simple but profound idea. Investing is not a game of wits, but a game of emotional control. As Buffett famously said, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. Let's unpack that. It means you don't have to be a genius. You just need a solid plan and the discipline to stick with it, especially when your emotions are screaming at you to do the opposite. Charlie Munger puts it even more bluntly. A lot of people with high IQs are terrible investors because they've got terrible temperaments. It's about being rational when everyone else is panicking or getting greedy. This is the core of the psychology of money. It's not about how smart you are, it's about how you behave. Think about the dot-com bubble in the late 90s. Brilliant minds were pouring money into companies with no profits and no real business plan, all because of FOMO, the fear of missing out. When the bubble burst, fortunes were wiped out. It wasn't a lack of intelligence that caused the crash. It was a lack of emotional discipline. So, how do we master our own financial psychology? The first step is recognizing our own biases. We all have them. There's confirmation bias, where we only seek out information that confirms what we already believe. There's herd mentality, where we follow the crowd, assuming they know something we don't. And then there's overconfidence, a particularly dangerous trait for smart people. Munger often talks about the importance of inverting your thinking. Instead of asking, "How can I succeed?" ask, "What could make me fail?" By identifying all the potential pitfalls, emotional reactions, stupid mistakes, following fads, you can actively work to avoid them. It's a mental toolkit for not being your own worst enemy. Now let's talk about risk. When most people think of risk, they think of volatility, the ups and downs of the market. But for Buffett and Munger, that's not the real risk. The real risk, in their view, is the permanent loss of capital. It's losing your money for good. This is a crucial distinction. The market will always fluctuate. Prices will go up and down. That's normal. Panicking and selling a great company's stock just because its price temporarily drops is how you turn a temporary dip into a permanent loss. Their approach to managing risk is beautifully simple. Know what you're doing. Buffett says, risk comes from not knowing what you're doing. This is why they preach the concept of the circle of competence. It means you should only invest in businesses you can truly understand. You don't need to be an expert on everything. You don't need to have an opinion on biotech, cryptocurrency, and emerging market bonds all at once. If you're a dentist, you probably understand the business of dental supply companies better than anyone. If you work in software, you have an edge in understanding tech companies. Stick to your circle. Inside that circle, your job is to become an expert. Understand the company's business model, its competitive advantages, its management team, and its long-term prospects. When you've done your homework, you gain confidence. And when you're confident in the underlying value of the business, the daily wiggles of the stock price become meaningless noise. You won't be tempted to sell in a panic because you know the true worth of what you own. This simple idea, only investing in what you understand, is one of the most powerful risk management tools ever devised. It's how you sleep well at night, even when the market is going crazy. This brings us to one of the most famous concepts from the Buffett-Munger playbook, the margin of safety. Imagine you're building a bridge. If you calculate that the bridge needs to support a maximum of 10 tons, you don't build it to hold exactly 10 tons. You build it to hold 15 or 20 tons. That extra capacity is your margin of safety. It protects you from miscalculations, unforeseen events, or just plain bad luck. Investing works the same way. The margin of safety is the difference between the intrinsic value of a business and the price you pay for its stock. Let's say you've done your homework on a company and calculated that its true worth, its intrinsic value, is about $100 per share. You don't buy it at $99. That's cutting it too close. Instead, you wait. You wait for the market to get pessimistic or scared, and you buy it when the price drops to, say, $60 or $70. That $30 or $40 discount is your margin of safety. This accomplishes two things. First, it protects your downside. If you were wrong in your calculations and the business is only worth $80 a share, you're still okay because you bought it at $60. You've built in a buffer for error. Second, it creates a massive potential for upside. When the market eventually recognizes the true value of the company, the stock price has more room to grow from $60 back to its intrinsic value of $100 or even higher. As Buffett says, the three most important words in investing are margin of safety. It's a simple, powerful rule that turns the odds heavily in your favor. It's not about timing the market. It's about buying great businesses at a price so cheap that it's hard to lose money over the long run. So, we have a rational framework, we know how to manage risk, and we insist on a margin of safety. But none of this matters without the final and perhaps most difficult piece of the puzzle: emotional discipline. This is where the rubber meets the road. It's easy to be a disciplined investor when everything is going up. The real test comes when the market crashes, when you see your portfolio value drop by 20, 30, or even 50%. Your heart pounds, your stomach churns. Every instinct in your body tells you to sell, to stop the pain. This is the moment that separates successful investors from everyone else. Buffett and Munger see these moments not as a crisis, but as an opportunity. When others are selling in a panic, they are buying. They're armed with their shopping list of great companies they want to own, and they're patiently waiting for the market to offer them at bargain prices. Think back to the financial crisis of 2008. The world felt like it was ending, but Buffett was busy investing billions into great companies like Goldman Sachs and Bank of America when nobody else would touch them. He was, as he says, greedy when others are fearful. How do they do it? It's not because they're emotionless robots. It's because their discipline is built on a foundation of deep research and a long-term perspective. They've done the work. They understand the value of what they're buying. They're not gambling on stock prices. They're buying pieces of actual businesses. And they have the patience to wait. They understand that you don't get rich overnight. As Buffett famously quipped, the stock market is a device for transferring money from the impatient to the patient. Building this kind of emotional fortitude takes practice. It means disconnecting from the daily news cycle, not checking your portfolio every 5 minutes, and trusting the process you've established. Let's tie it all together. What is the ultimate secret of Warren Buffett and Charlie Munger? It's not some complex algorithm or a secret formula. It's a philosophy built on rationality, patience, and humility. First, recognize that your own psychology is your biggest hurdle. Master your temperament before you try to master the market. Build a mental toolkit to combat your own biases. Second, define risk correctly. The real risk is not volatility, it's the permanent loss of capital. You avoid this by staying within your circle of competence and knowing your investments inside and out. Third, always demand a margin of safety. Buy wonderful businesses, but only when they are offered at a significant discount to their true value. This protects you from errors and maximizes your potential returns. And finally, cultivate unshakable emotional discipline. Be prepared to act rationally when everyone else is losing their minds. See fear as your friend and market crashes as opportunities. The journey to financial success is not a sprint, it's a marathon. It's about making a few smart decisions and then avoiding major mistakes over a lifetime. It's about character, not just intellect. As Charlie Munger says, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. So, don't worry about having the highest IQ. Instead, Focus on building a rational temperament, being patient and staying disciplined. That is the true path to wealth, and it's a path that's available to every single one of us. Thanks for watching. If you found this deep dive into the wisdom of Buffett and Munger helpful, make sure to hit that like button and subscribe for more content that helps you think smarter about money. Let us know in the comments which piece of their advice resonated with you the most. See you in the next video.